Hi, everyone. Thank you for joining me this morning. We've had a very tumultuous, volatile market the past few weeks, which has been great for options trading. Options do very well in volatile environments. We've been making a lot of money for our subscribers. The title of my talk is The Options Miracle System, how to generate 30% annualized returns in a stagnant or even falling market with limited risk. I am the Chief Investment Strategist of Jim Fink's Options for Income, and you can check out the service at the URL below, www.investingdaily.com/webinar. You can get a special price on a trial subscription to Options for Income. That's what I look like, in case you're interested to know who's speaking. Now, this is a very pivotal time for the markets. On this previous week, I think it was on Wednesday, we briefly touched a 10% correction for the S&P 500 intraday. It closed last week down about 6.6%. So on a closing basis, we haven't had a correction yet, and it seems likely that we will retest that 10% intraday decline at some point. Russell 2000, the small cap index, has already hit correction territory down at one point over 13%. So, you know, the calm, serene, gently rising markets of the past 3 years seem to be coming to an end, and we're going to be entering a more volatile period now that the Federal Reserve is set to end its bond buying QE program. Probably at the October meeting, they'll declare that the bond buying has been finished. So when we're entering a more normal economic environment, volatility will return because we won't have that constant support coming from the Federal Reserve's monetary stimulus, which is not a bad thing. It just means that we're entering a more normal volatile period, which is good for options trading. Even after the current 6.6% decline in the S&P, stocks are still arguably significantly overvalued, where conservative option strategies can definitely be beneficial going forward. Now, Yale economics professor James Tobin, he's no longer with us. I was fortunate enough to have him as a professor when I went to Yale back in the 80s. He developed a market valuation tool called the Q ratio, which is the market price of the stock market divided by asset replacement cost. Asset replacement cost is similar to book value, but it's better because it's based on market values, not historical accounting values, which are often inaccurate and too low given inflation and such. Today, Andrew Smithers, a UK money manager, maintains the Q ratio at his website, smithers.co.uk. You can go there to see it. Based on the current Q ratio, the stock market is overvalued significantly by 79%, which means the Q ratio is 79% above its long-term average. Reversion to the mean would suggest it will go down to its long-term average at some point. 79% overvalued is right near the overvaluation peaks from prior beginnings of bear markets. Obviously, all bear markets start with a 10% correction, but they keep going. So just because we've had an intraday 10% decline doesn't mean it's over necessarily. Robert Shiller, another Yale economics professor who recently won the Nobel Prize in economics, I also had him when I was at the school. He has a similar valuation technique based on the cyclically adjusted 10-year PE ratio of the S&P. Currently, it's at 26 times 10-year average earnings versus the long-term medium average of 15.9%. So according to his ratio, which is called the CAPE, cyclically adjusted 10-year P ratio. The market is 64% overvalued, which is obviously expensive as well. Now, Warren Buffett has a similar valuation technique where you take the market cap of the stock market as a whole divided by gross domestic product. He's been quoted as saying that this ratio is probably the best single measure of where valuations stand at any given moment. As of the last reported figures, the U.S. GDP is $16.8 trillion. The total market cap of U.S. stocks is $19.8 trillion, and that's a ratio of 1.18, 118%. In other words, that means that stocks are more valuable than the U.S. economy, which should scare you a little bit. Stocks should not be more than the U.S. economy, but right now it's 118% of the U.S. economy. And since 1970, there have only been 3 times where the market cap is even equal GDP, let alone be above GDP. Market bubble, internet bubble of 2000 was the worst case. It was 148% above GDP, and NASDAQ subsequently lost 78%. 2007, 111% ratio resulted in the 2008 market crash, where the S&P lost 56%. So right now we're back at those nosebleed levels. So far we've lost 6.6%, but based on this precedent, that could just be the beginning. Definitely not the end. Economics PhD John Hussman has been quoted as saying that the correlation between this market value to GDP has been 90% with the subsequent 10-year total returns of the S&P 500. Based on its current overvaluation of the market, he's projecting annual total returns for the S&P of only 1.8% per year for the next 10 years. So buy and hold index funds, you know, you're only expected to make 1.8% per year. I think an option strategy that could generate 30% per year sounds much more attractive than 1.8% buy and hold. I think you would agree. So here's a technical warning sign. This is a chart of the S&P 500, a weekly chart. This past week, ending October 17th, was the first weekly close of the S&P below its 40-week moving average, which is similar to the 200-day moving average, which is similar to the 10-month moving average. They're all the same thing, but on a weekly basis, as you can see in this chart right here at the very end, the S&P closed below this red line, the 40-week moving average, first time since back here in November 2012. So something's changed. I mean, look at this uninterrupted period has come to an end. Does this mean that the trend is going to keep going down? Not necessarily, but I think we need to be kept aware that something has changed that's rather significant. So something to keep in mind. All right. So, and lastly, another last warning sign is insider selling. Since the October stock market correction, this insider selling has dried up a bit, but right before that, this was a good warning sign. Insider selling was, in September, was as pessimistic as this finance professor from University of Michigan. It's as pessimistic as he's seen it in over 25 years, more pessimistic than in 2007 before the bear market, more pessimistic than 2011. And market sentiment remains very bullish even after this market decline. The longest period where bulls have outnumbered bears by 3-to-1 since the 1980s. So caution is warranted. Now, why is it so important to prevent losses? Well, I like to show this chart called the loss-gain asymmetry. It shows you that whenever you lose a certain amount, to break even you have to gain even more. So losses are more damaging to your portfolio than gains are beneficial. I mean, if you lose 40% on a portfolio, 40% gain will not get you to break even. You would have to gain 67% just to break even. If you lost 50%, you would have to double your money to break even. So this emphasizes the point that Warren Buffett always makes. Lesson number 1, don't lose money. Lesson number 2, don't forget lesson number 1. And that's why conservative trading, loss reduction is critical to long-term wealth generation. The profits will take care of themselves as long as you prevent the big loss. So I view option strategies as a loss reduction, conservative way to invest in stocks that will prevent the big loss and yet provide substantial gains even in a stagnant or declining market. There are 3 different strategies that I use on a regular basis. Number 1, I like to sell out of the money put options, which is selling low probability fear to people who want to buy puts at almost any price because they're scared the sky is falling. So we sell out of the money puts. Then number 2, we buy high probability growth, which is in the money call options, long-term call options, where stock price appreciation of a reasonable degree is likely to occur. So I'm very willing to pay for that likelihood. And also we sell out of the money call options as bearish hedges. People are willing to buy or get greedy, and they're willing to buy low probability call options above the current market price. And you know, these big stock gains are probably not going to happen, so we're very willing to sell them their greed and make income on the upside of the market potential. And so we like to sell low probability and buy high probability. I want to mention something in my options for income service that it makes us unique in the industry. It's called the Options for Income 10-Year Stock Seasonality Navigator. Now, seasonality refers to particular time frames during the calendar year when a company's stock price is influenced by recurring forces that produce a consistent price direction, either bullish or bearish. Some stocks tend to go up consistently at certain times of the year. For example, consumer-related stocks like food, drugs, beer, leisure, utilities, retail appear to outperform the overall market in the summer months between May 1st and October 31st, whereas manufacturing and production stocks that are consumer durables, chemicals, construction, mining appear to outperform historically in the winter months between November 1st and April 30th. Now, you know, there are a lot of theories as to why these seasonal tendencies occur. They can be based on weather events, spending surges, new product announcements at industry conferences, financial events. There's no way to prove exactly what causes these seasonal tendencies, but the observation is they do exist, and you can make money trading these. Now, we have a seasonality navigator that allows you to take advantage of these seasonal tendencies. Most options services don't provide this. As you can see, the navigator, when you get it off of our website, has 2 sides. The left side gives you the percentages, these between 0 and 100, that a stock has risen between a certain start date, which is the start date you can select up here on the top left corner. Right now, this one shows December 18th, 2013. Between that and the expiration date of the next 6 expiration months. So back in December 2013, the next 6 expiration months were January, February, March, April, May, and June. So let's take, for example, BKE, which is the Buckle, a retail stock of jeans, denim jean, Midwestern company. As you can see that between December 18th, 2013 and February options expiration in 2014, Buckle rose 100% of the time. So that means that every year for the last 10 years, Buckle stock has risen. Now, if you go to the right-hand side of this software, it provides you with the data for Buckle on a yearly basis. So the left side is frequency, how often a stock rises. The right-hand side gets into more micro detail for each particular stock and shows you the strength of the stock move each year. So here in February, if you look at the February expiration for the Buckle, you will see the amount the stock has risen each year for the past 10 years between December 18, 2013 and February expiration. For example, in 2004, the stock rose 23%. In 2006, it rose 20.5%. Every year, it's gone up. Some of the years have been less, like in 2013, it only went up 0.4%, but it still went up. So if you're selling put spreads, which is what I do for a living and my bread and butter trade, you don't care how much it goes up. You just don't want it to go down. So even if it only rose 0.4%, you would have still made maximum profit on an out-of-the-money put spread. So this is a very useful part of my options for income service that you can't get anywhere else. Many of my subscribers have said this software tool is worth by itself the value of the subscription. They come up with their own trades using this, so it's very valuable. Okay, let me just get out of this. All right, so let's start with the first low-risk strategy. It's the easiest strategy. It's called buying long-term call options, or LEAPs. It's a stock replacement strategy that is most like your normal stock trading. So beginning options traders feel most comfortable buying long-term calls because it is the easiest to understand. This would be the number 2 strategy, the buying high probability growth, where you're buying an in-the-money long-term call option. One example I like right now is Apache Corp. It's an oil and gas exploration company. It's got great long-lived assets throughout the world, constant cash flow, strong balance sheet. All oil stocks have just gotten crushed over the past few months as oil prices have declined out of fear of slowing global growth in China and the Eurozone, and oil stocks have fallen in sympathy with the reduction in oil prices. But Apache is one of the strongest oil companies, and it's just at an incredibly cheap price right now. It's a perfect candidate for a long-term call option. So one you could do, Apache right now is trading at $72.85. You could buy the January 2016 $70 call for $11.50 per share, or $1,150 per contract, because each contract represents 100 shares. It expires in 453 days, so there's plenty of time for this trade to work out. The upside break even, you just take the cost of the call, add it to the the call strike, and you get 81.50. This is an 11.9% premium, $8.65 more than the current stock price of $78,285. So, you know, the stock would have to go up by more than 11.9% to make money, but it is just so cheap right now that I think that's very likely to occur. Now, why is this a low-risk strategy? Because it has a tremendous cost advantage over buying 100 shares of the stock. One contract will only cost you $1,150 compared to $7,285 for buying 100 shares of Apache. So you're putting 84.2% of your capital, less of your capital at risk. So if things don't work out as planned, your exposure is dramatically reduced. For example, if Apache were to drop an additional 35% from its current reduced cheap level down to 47.35, the most you would lose on this option leap call would be $1,150, which represents 15.8% of the value of the stock. So as you can see, your loss is less than half of the 35% stock loss. The stock would lose $2,550. $2,550 is more than double the $1,150 from purchasing the leap call. So your loss would be 122% greater by buying the stock. So this is an example of how call options can reduce your risk. Now the delta on this long-term 70 call is 60%, meaning that as of right now, for each $1 move in the stock, the option value will increase 60 cents. But the longer you hold this call, the larger delta becomes, so that by expiration, you get 100% delta, and every dollar move in the stock represents a dollar move in the option. So you get more bang for your buck as the option gets closer to expiration. Now, if the stock were to rise back up to 90, which seems incredibly reasonable to me given its value as a company, I value the stock at way over $100 a share, so it should be able to get up to 90 within 453 days. That would represent a profit of 73.9%. You just 90 over 70 is $20 gain. You paid $11.50 for it, so that would be a 73.9% gain. That's a much higher gain than if you just bought the stock at $72.85 and sold it at 90, because that would only represent a 23.5% gain. So the leverage of buying the call option is more than 40.4 percentage points higher than just buying the stock. So you get a much higher rate of return for much lower risk exposure. So that's a double whammy benefit with buying leap calls. Now, you could do this with your entire stock portfolio, and it shows you that buying calls helps not just on an individual position, but you could replace your entire stock portfolio with leap calls and come out way ahead. So let's give an example. 150,000 equity portfolio. Let's say a reasonably diversified stock portfolio would have 20 individual holdings, each worth $7,500. 100 shares of Apache cost $77,285. So that's roughly a little bit less. But if you had 20 different stocks, each costing about the same as Apache, that would represent the 150,000 portfolio with 20 positions of each being 7,500. Instead of buying the stock, you could buy this leap call for $1,150. It gives you virtually the same profit potential, but for 84% less cost. So if you extrapolated this one example to all 20 of your stock holdings, found a leap call to replace each of the 20 different stocks in your portfolio, you could have a total equity option cost of only $23,000. So, you know, 1,150 per contract. You have 20 of those contracts representing 20 different stocks in your portfolio. 20 times 1,150 equals 23,000. So that's all the money you have at risk. You subtract that 23,000 from your 150,000 total portfolio, and that leaves you in 127,000 of your portfolio in cash. Cannot lose money. That's there, protected from any stock market decline. So that you've got the same upside exposure, and yet you've got $127,000 of your portfolio in safe cash. That's the benefit of using leap calls versus buying stock. Now, the maximum dollar loss of this leap call portfolio, as I said, was $23,000, which represents 15.3% of your 150,000 portfolio. This means that you have the same stock appreciation, but your stop loss is 15.3%. Many people are willing to have, can find a 15% stop loss tolerable for their portfolios. So leap calls are kind of like a built-in 15% stop loss. And this is much less than the 100% potential loss from an all-stock portfolio where everything could just go down to zero. Stocks must rise to make money in both the call option and stock scenario, however. Unlike more advanced strategies I'll talk about in a moment, buying leap call does not benefit from time value decay. You have time values working against you, so definitely you have to get the direction right, but your money at risk compensates you by being much less. So let's go to the more advanced strategy now. Put credit spreads. This is my bread and butter strategy. I like this strategy because unlike buying leap calls where you have to be right on direction, with selling put spreads, you can be wrong on direction and still make your maximum 25–30% profit. I like that. I like the cushion of being wrong on direction and still making maximum profit. So based on our three strategies, this would be strategy number one, where you're selling low probability fear. You're selling out of the money put options to people who are frightened that the sky is falling, which it never does for long. Now, what is a put credit spread? When you sell a put, you assume the obligation to buy the stock at the strike price that you sell. You get a fixed amount of instant cash up front, and your risk is limited to the width of the put strike. So if you were to buy a 50 put, sell a 50 put, buy a 45 put, your risk would be limited to that 5-point difference between the strikes. Even if the stock were to fall down to $2, your risk is limited to having the stock fall to 45. Anything below 45, you're covered. So that's very reassuring. Now, the good thing about this is that the stock price does not need to rise. You get the maximum profit even if the stock does not rise, or even if it falls a little bit. For example, $50, $45 put spread. If the stock's trading at 54 when you put on this 50-45 put spread, the stock could actually fall $4 from 54 down to 50, and yet you still make your maximum 30% profit. When you put on the trade, you thought the stock would go up, but my point is, even if the stock were to fall a little bit, and you were totally wrong about the stock rising, you make your maximum profit. That is extremely attractive to me, and it's extremely attractive to all of my Options for Income subscribers. Everybody loves selling put spreads for that reason. Now, selling time value is basically what selling put spreads is. Time value is the surcharge on an option price that is based on speculation, based on what people think the stock will move in the future. Usually this expected move is exaggerated, so by selling this time value surcharge, you are usually getting more money than the what is justified by subsequent reality. So There have been many studies showing that selling options, selling time value is a profitable strategy because time value is so often overvalued by option buyers. There are three examples of this. Well, there are three examples. PBP is the buy right ETF. That's based on buying the S&P 500 index and selling at-the-money call options against that. So it's very similar to selling puts, but it's more capital intensive. So I don't like covered calls because it requires more capital, even though it has no greater reward than selling puts. But PBP is the buy right, buy the index, sell a covered call. And then you've got PUT right here, which is the put right index where you sell an S&P at the money S&P 500 put. Unfortunately, there's no ETF that lets you do that. There is an ETF on high volatility put right ETF, HVPW, but that is not the same thing as the CBOE S&P 500 put right index. It's a different product, different underlines, put options. It's based on individual stocks, not based on the S&P 500. But my point here is that during bear markets, selling put options is less risky than owning the stock. The best example is the bear market between December 2007 and March 2009. The S&P 500, which is represented by SPY here, the S&P 500 ETF, that lost 52.3% during that bear market period, whereas the buy right index, the PBP, only lost 39.3%, and the put right index lost even less at 35.9%. So your risk was reduced by selling options versus buy and hold. Even in a bull market, the past year, between October 17, 2013 and October 17, 2014, the selling options has done reasonably well. Obviously, in bull markets, buy and hold will usually beat selling options because selling options is fixed income, whereas in a bull market, there's no limit to how much you can make. So if it's a strong bull market, buy and hold will usually win out. But my point is that even if you don't make as much as buy and hold in a bull market, you still generate positive returns. And so selling options works in any stock market environment. It definitely outperforms in bear markets, but even in bull markets, it does relatively well. So over the past year, where the S&P has risen 10.9%, the buy right index has risen less, but still positive at 5.9%, and the put right index has risen 6.0%. As I said, there's no put right ETF. There is this high volatility ETF, but as you can see, it significantly underperformed the CBOE S&P 500 put right index. It only rose 0.8%. So I don't think it's really that attractive a investment product. It uses high volatility, high risk stocks to sell put options on, and often those high volatility stocks crash because they're very risky. So just this is a good example of why just choosing to sell put options on the most volatile stocks that offer you the highest option premiums is not a good idea, because often those high premiums are justified by the high risk of the stock crashing. So 0.8% is not worth investing in, so I do not recommend HVPW. Okay, so let's move on. Now, the thing to remember with selling put options is that for individual stocks is that They can be exercised early against you, so you have to be prepared to buy the stock at the strike price. It doesn't happen very often, and when it does happen, it's no big deal. What you do is you end up buying the stock at strike price, and if you pick the strike price correctly, you know, the worst thing is you own a stock at a discounted price from the current what the market price was when you sold the put, and you can, you know, just buy the stock that way. Many people use just sell puts in order to buy stock at a discount. But if you don't want to own the stock, it's no big deal. You just sell the stock. So you get an assignment, and the next day you just sell the stock, no problem. Good thing about early exercise is that there's no margin call involved. Your broker gives you 1 day to sell the stock without, even if your account doesn't have the adequate margin to buy the stock as part of an early assignment, they will not issue a margin call against you. So don't worry about that. Don't worry. I always get questions about, well, I don't have enough money to buy the stock if assigned. And my answer is, yes, you do. If it's part of an early assignment, your broker does not require that you have that amount of money. There will be no margin call. All you have to do is sell the stock on that day, or your broker will sell it for you if you're not around. They're not going to assume any of that risk that you can't handle. So the stock will be liquidated, and there's no problem. So don't worry about it. It's called the same-day substitution rule if you are concerned. Okay, so let's see. Do I have an example here? Yes. Advanced Auto Parts. Looks like a good trade for a put spread right now. It's trading at 135.97. If you were to use the Options for Income Seasonality software application, you would find that over the past 10 years, between October 17th and December expiration, Advanced Auto Parts has risen each and every year. 100% of the time it's gone up. That's the type of stock you want to trade a put spread on. So one example right now would be to sell an out-of-the-money put spread. You'd sell the December 130 put. Right now it's trading for 410. You could buy the December 125 put at 290. The net credit for this trade would be 120. Potential rate of return would be 31.6%. You take the net credit of 120. You divide that by the risk of loss, which is the 5-point spread width minus the initial credit received. So if worst case scenario, you'll lose 380 on this trade. But best case, you'll make 120. So take 120 over 380, and you get a 31.6% return for 62 days of exposure. Now, oh, I got disconnected. Is everybody there now? Hello? Okay, I'm assuming that you can hear me. So 31.6% rate of return for 62 days of exposure is a good return. Break even on this trade would be 128.80, and you get that just by taking the put strike of 130, subtracting out the initial credit of 120, and if the stock were to fall to 128.80 at expiration, you would break even. Anything below 128.80, you would lose money down to worst case of 125. And the break-even discount to the current stock price is 5.1%. So this shows you how selling time value works in your favor. Basically, your break-even is, if you bought the stock, your break-even is the price that you buy the stock at. But with these put spreads, you have a 5.1% cushion. The stock could actually fall 5.1% from its current price, and you would still break even. So that's the low-risk conservative aspect of this type of trade. Okay. So let's go. Put spreads can be used like leap calls to build an entire portfolio. Now there are two ways to use leverage. The bad way would be to buy more stock for the same amount of cash. So for example, Advanced Auto Parts, 100 shares would cost you $13,579. Since one Advanced Auto Parts put spread can be sold for a risk of $380 per contract, one could actually sell 35 put spreads of Advanced Auto Parts for the similar $13,000 risk of buying 100 shares of the stock. So you basically leverage yourself 35 times over. That's a bad way to use leverage with options because the risk of total loss on options is much more likely than with stock. For example, you'd lose your entire investment if Advanced Auto Parts fell to 125 or below, whereas with stock, obviously, you wouldn't lose your whole investment unless the stock fell all the way to zero. So you do not want to risk as much as you would with stock. The whole point of leverage is to let you get the same amount of exposure to the stock, but using much less cash. So you would sell, the better way to use leverage is to sell one AAP put spread for $380 of risk, which is 97% less risk than a 100 share purchase of $13,500. And this way you could do this 35 different times with different underlying stocks. And so for the same value as buying 100 shares of one stock, you could buy 35 different put spreads on 35 different underlying stocks for the same amount of money. This is the good way to use options leverage. It provides you with portfolio diversification for the same amount of money, so it is risk reducing. With the portfolio construction, you can see you could do similar to with leap calls. You could replace all of your stocks with put spreads, and I'm not going to go into it right now. It's a little complicated, but you'll see that you save a lot of money and you get the same amount of income by doing put spreads instead of individual stocks. Last strategy, Iron Condors. This would be using both strategy number 1 and strategy number 3, where you sell out of the money puts and sell out of money calls. Now here's the seasonality of IBM. I used the Options for Income Seasonality app yet again. And what I like about IBM for an Iron Condor is, as you can see, the stock has moved less than double digits in 9 out of the past 10 years. The only year it went double digits was 2013, where it hit 10%. All the others are single-digit gains. Thing with Iron Condors is you don't want it to go up all the time, and you don't want it to go down all the time. You don't care the direction. All you care about is that the magnitude is small, and yet you still can make good money on an Iron Condor trade. Frequency of up or down is not important. The magnitude of yearly moves is what it counts. And with IBM, only 1 year out of 10 had a price move in double digits. All the 9 other years saw price moves of 9.6% or less. So the conclusion is a good Iron Condor trade on IBM would be to choose short call and put strikes, 9% out of the money, both up and down from the current stock price. Here's a chart of IBM. You can see it's been in a trading range. There's no real trend here. Down here, on the bottom, it's about 170. On the top, it's about 200. So it seems like doing a put strike down in this area and doing a call strike in this area would be a high probability trade, not only based on the chart itself, but based on the seasonality of IBM not to move much over the next 3 months. So here's the trade. You'd sell the January 165 put, buy the January 160 put. On the downside, on the upside, you'd sell the January 200 call, buy the January 205 call on the upside. And the net credit for all of these things is $1.10. Potential rate of return is 28.2% because you're getting $1.10. Your risk is only $3.90 because the most you can lose is 5 points because you can't lose on both of these. Either the stock goes up or it goes down. It can't be in both places at the same time. So your risk is limited to $3.90. So that's a good rate of return for 90 days. Break even is $163.90 on the downside, $201.10 on the upside. So that's a range of 10% down, 10.5% up. Maximum profit range is 35 points wide, which is it's a very nice cushion between $165 and $200. The benefits of an Iron Condor, you get a double credit, and yet you only have a single margin requirement. You can't lose on both of the credit spreads. You're guaranteed to win on at least one of them. So that's why the risk is limited to only one of the two spreads. January put spread has a 60-cent credit, which means it has a 440 margin requirement on the 5 points spread. January call spread is a 50-cent credit, so it has a slightly larger margin requirement of 450. So if you had done these trades separately, the two margin requirements would have cost you $890, but the Iron Condor margin requirement is only $450, which is the larger margin requirement of the call spread. So it saves you a lot of money doing an Iron Condor.
Hey, Jim, I don't mean to interrupt, but we're looking at about 2 more minutes left.
Okay, thanks. So the cons of the Iron Condor are you need to worry about 2 short option strikes, not just one, so you're vulnerable to a strong move in either the bullish or bearish directions. You know, you could be right that it won't go up much, but if you're wrong on the downside, you could lose, and vice versa. Also, there are 4 option legs, so commission cost is heavy, but the rate of return compensates you for that. So just to summarize the three trades I have today, the simplest trade is a long-term call option. You would buy Apache Corp. January 2016 70 call for a debit of $11.50 or less per share, or $1,150 per contract. Medium trade would be short put spread, sell Advance Auto Parts December 130. I'm sorry about that. It should be December 130, December 125. Forget the September. It's a December trade for net credit of 120 or more. And the more advanced would be the short Iron Condor, where you sell the IBM January 165, 160 put spread, sell the January 200, 205 call spread for net credit of 110 or more. All of these trades look good to me. I was going to talk about downside protection hedges, but that will have to wait. But you can read about it at your leisure when the presentation goes up on the website. So that's all I've got for my time constraint. Again, the product, the service that I offer is Jim Fink's Options for Income. You can learn more about it at the URL below, www.investingdaily.com/webinar. Please check us out. You can check out the track record. You can also check out the Seasonality Navigator application, which people just love. I think once you try out the Seasonality Navigator, you'll get hooked. You have a 90-day free trial to the service, so there's no risk involved for giving us a try. I think you'll be happy with the service, and thank you so much for your time, and I hope to see you on the Options for Income discussion board. Thank you very much.